How's it going, everybody? Thank you for stopping by. I really, really do appreciate you. I want to start off by letting you know that this conversation is going to be general and impersonal in nature. It is not specifically tailored towards you. We are not licensed financial advisors, so you do not want to listen to us. This video is not going to include any financial advice whatsoever. On top of that, the companies that are going to be mentioned in this video, either I own them or the person I'm talking to owns them, or we know people who own them or whatever. We're going to be biased on the investments that we're going to be talking about. But again, this conversation is general and impersonal in nature. So only listen to us if you want to lose money, okay? Otherwise, do your own research and contact a licensed professional individual, okay? With all that said, Christian, thank you for investing your time with me today, sir.
Thank you, Antonio. I'm looking forward to it.
Oh, me too. It's a definitely interesting topic that I'm planning for here today. But first things first, though, Christian, this is the first time that we're speaking, and although you're very likely more famous than me in this sector, but I'd like to assume for a second that nobody knows that. So why don't you tell me who you are and why you think you're worth listening to?
Sure. I'm a mining professional here based in Toronto, Ontario. Mining is pretty well the only thing I know. I've been immersed in it in the last 18 years. I got a degree in Metallurgical Engineering from the University of British Columbia. Worked as an engineer for several years. Figured out that I like making money more than being an engineer, and migrated to the investment banking side in 2007. I was an investment bank for 10 years in the mining sector, raised about $7 billion for mining companies, advised on about 40 M&A transactions of all sizes. One of my best clients, Altius Minerals, great company, by the way. ALS is the ticker in Canada. Decided to, or convinced me to leave investment banking to start Adventus Mining Corporation. Adventus is TSXV listed, ticker is 80ZN. We're building a copper company in Ecuador. So I've been running Adventus for about 5 years. We've raised $130 million in equity to build this copper business. And recently been branching out into directorships, chairmanships of other mining companies. It gives you a snapshot.
Yeah, definitely does. This is basically the main reasons why I wanted to talk to you today. As you said, about 10 years in investment banking, you raised more than $7 billion in those 10 years. So I like to believe that's about $1 billion a year. So that's a lot of money. And you took, you assisted in 35 M&A deals, but you've probably gone through much more deals, right? So that made to be able to do those 35. So that made me think that you've probably also seen a fair share of bad deals, bad companies in the natural resource space in general. So that's why I invited you here today to sort of help me save me some money and teach me how to stay away from bad deals. What do you think?
Absolutely. I mean, the minute I could buy a stock, like old enough to buy a stock, I was buying a mining stock. So that was a while ago. And the global financial crisis almost wiped me out financially. And over the last 10 years, I've been building a decent net worth. But I've seen it all. I've had people completely screw me over. I've invested, I would say, too conservatively in a lot of times. But generally, I've got the pieces right, I would say, these days. The mining sector has about 2,500 companies globally, about 1,500 on the TSX, TSXV, CSE. It's a lot of companies for investors to digest. Specifically looking in Canada, out of those 1,500 companies here, I would say 100 to 200 are maybe worthwhile looking. The rest are a waste of time. And unfortunately, they're eating up capital and investor focus from the good companies.
So is that about 10%?
10%, yeah.
Wow. Okay, that's not high. What type of companies have you? Because you said people completely screwed you over. What type of companies have you gotten screwed over the most on? Like, is it early the exploration, development stage, producers? What do you hate the most?
Yeah, I don't want to go into the exact details of these scenarios, but I typically have a pretty good nose for good projects and good people in this space. But every so often, someone can show up in this business that on the surface has all the attributes, says all the right things, got good nose for projects, but is completely focused on themselves. They're narcissists. And you start getting to business with them, or you start investing in their companies, and it is all about them and not about the shareholders. So you got to be very careful about those kind of characters. And unfortunately, there are a bunch of them lurking in our business, and many of them in Vancouver. So beware.
Well, that's exactly what you're here today, to help me sort of see those things coming from afar. And let's maybe take it a sort of step-by-step approach. As I sort of told you offline, that I've been trying to put together my own research framework when it comes down to junior natural resource companies specifically, and it really involves mostly me stealing parts of other people's research frameworks, but anyways, it's sort of working for me so far. But first and foremost, I generally start off by looking at what I call the primary metrics. So that you know, think about stuff like the market cap, the enterprise value, and therefore the cash and debt situation, options and warrants overhang. That's an important one for me too. Insider ownership, and just general, very tangible numbers that you can sort of glance on, put on a spreadsheet for like 5 to 10 minutes tops, and then decide if you want to deal with the company or not. So what are some of the major red flags that can kill off an opportunity for you off the get-go?
I'm going to take a step back, but on the same theme. Because there's so many companies in the mining space, almost all of them searching for capital. You're trying to find the team that is got the best chance of raising capital in the business. And typically it goes hand in hand with people. So when I'm screening for companies, the very first thing I do is I look at the board of directors of a mining company. If I don't know anybody in the board, or if nobody in the board has had success in the mining sector in the past, success means a new discovery, a major sale of a company, built a company up from scratch, been able to raise a substantial amount of money, either as a service provider or in the companies they're involved, I wouldn't touch it. So people would be number one. And generally, those people who have been successful probably have a good nose for projects as well. You need to have good people to raise capital. And so it goes hand in hand. Then you look at the shareholder register. That's the second thing I look at. The resource sector is very cyclical. And just because there's a major investor that's putting money into a story in one part of the cycle, you may lose that investor in another part of the cycle. So it's best to have multiple significant shareholders that can write good checks for the company. Now, of course, this is more focused on the junior end of the spectrum, but the majority of those 1,500 companies in Canada would be sub 200 million market cap. So I want to see multiple recognizable funders, whether it be institutions, private equity, corporates, etc., that will ensure a lifeblood to the company. I would give the weighting on people and being able to raise capital and identified shareholders is probably 60% of their overall cachet of a mining company. Then I look at the projects after that. So that's my intro to your question. Now, you talked about market cap, cash, debt, EV, options and warrants. Market cap to me is important, but it can be misleading. Through tight share structures, promotional activities, etc., you can have very large market caps for companies that are significantly overvalued. I mean, market cap gives you a gauge of where it should fit in the food chain, but it's very dangerous to just look at market cap. I would say that there are quite a few companies that are trading in the sub 50 million market cap that probably should be are completely mispriced. It should be 300-400 million market cap. So, and vice versa on a high end. In terms of cash and debt as an exploration development company, kind of pre-construction, you don't want to have any debt on your balance sheet. If you see secured debt or other forums, be very wary. You need to go back to your first principles. Who are the people involved? Who are major shareholders? If there is a bump along the road, can that company repay the debt? So I would avoid companies that have debt pre-construction. And then cash-wise, some companies have very high G&A spend. You need to be wary of those, but sometimes you need to spend money in order to attract the best people in the business to be able to drive the business forward. So be wary of companies that are running out of cash over the next 3 to 6 months. There's likely a financing to come, and if you're in a market condition like today, it's going to be painful to raise capital unless you have one of those key shareholders or directors involved. Make sure there's enough capital in the business to cover G&A for a good period of time. But that's all scalable based on the business and the milestones, etc. So your first category on market cap, cash, debt, EV, it's an important metric to look at, but it wouldn't be the primary way I would be analyzing a mining company. Options and warrants. If you can find companies that don't have warrants, those are better. Adventus, one of my companies, didn't do a unit transaction until this year. So 5 years into the business, and we did it because we need to raise a significant amount of capital to build our mine. But warrants aren't great in the business. They can definitely provide an overhang, as you suggested. Options. There is a reasonable amount of options, RSUs, those kind of securities that I think should be incentivization for management and board. And then there's outrageous. And I've seen outrageous in my career, typically Vancouver companies again. Be wary about those that are stuffing their pockets with those kind of securities and not actually putting real cash into the business. But the concept of options and RSUs and those kind of things is completely valid, and I think is important to be able to attract top talent.
And is it, because I hear you mention Vancouver a couple of times? Is it a red flag if a company is based in Vancouver mostly?
No.
Okay.
No. It's not a red flag. There are a lot of junior companies in Vancouver, and there's a lot of schemes to get rich in Vancouver. But there are a lot of good companies in Vancouver as well. So it's just in my career, I've seen more interesting schemes in Vancouver than other cities.
Okay, so okay, well then maybe pay closer attention to that. That's a fair warning, I guess. And you mentioned the team. Your intro was great, and you mentioned the team a lot, and that's what I want to move on to from here. And I obviously I'd look at who runs the ship there as well. I guess it's harder for me because I don't know too many people in the industry relative to the amount of people that you know. And so I would try to research their backgrounds. And when it comes down to researching the team, I guess that's an interesting part, because this sector has a horrible image problem, which you know, obviously. But I mean, before I came into the sector as an investor, maybe let me tell that I imagine this sector has a bunch of old white dudes who scam communities around the world, and retail investors pay for their lifestyles of private jets and escorts. And so that's exactly the thing. I found that to have been true, basically, now that I've looking at some of the stuff that some of the CEOs have been doing in the 80s and in the 90s. Some of the stories that I've read from back then they're interesting, to say the least, the very least. But the thing is that some of these people who used to do these things back in the 80s and the 90s, they're still employed, right? They're still around. Some of them run juniors. They have their own companies. Some of them have positions higher up in producers and stuff like that. So I was just wondering, how do I deal with that if I cannot find too much background information on the team? So that'll be sort of the first thing that and let me make it a two-part question, but how do I find for information? And do I really care about what they did in the 80s and the 90s? What do you think?
So what people have done in the past, I think that's hard to really dig up, especially back then where there wasn't the internet and the like. So it's you learn more about that through word of mouth. Insiders of a company should have a bio on a website or corporate presentation. You can look at the management information circular of each company on CDAR, get a sense of if there have been any bankruptcies or what other companies they're involved in, also the compensation. You can look on sedi.ca to look at insider holdings as well. And just a kind of a Google search probably picks up everything you need to know from a high level, and you can do a little bit more research on companies that person might have been involved in the past. But if someone has been successful in the business, it should be all over that biography that's on the website of the corporate presentation. You can then look up, what was that success, and maybe put it in a different shed a different light on it. In terms of the people in the business, well, it's a very interesting, dynamic business. These are projects. When you look at mineral deposits, you have to travel in the world to find the best ones. You can't just focus on your backyard. Okay, I'm going to find the best vanadium deposit or iron ore, etc. You have to go where the deposits are. It takes you around the planet, some very interesting places, which inherently is risky. And you got this boom and bust type of business, which is not for the faint of heart. And I would say that when someone is very successful through a new discovery, or you're near at the top of the market and money is just being thrown at you, people can get into a state of euphoria and silly things can happen. So I've seen it. I've seen some of the behavior as you suggested. Perhaps some of those people would regret maybe some of the decisions they've made. I wouldn't just blanket it as that person is bad just by one incident, but there are definitely people that have a reputation like you've talked about, and it goes back to it's all about me. It's not about the shareholders, and that's something to watch out for.
Mm-hmm. And it's maybe a good idea to, if someone is trying to be serious about this sector, like I hope I'm going to be here long term and I want to be serious about this sector, might be a good idea to build out a network. And if you're looking into a new project, you don't know the team, maybe ask around, ask people that you trust in Vancouver or in Toronto or whatever. I think that's also a good point that you brought up. And I guess you're sort of, I want to make it, I know it's a cliche to make top 3 lists, but I want to make sort of a top 3 list of some of the red flags or maybe some of the most important things to look for in a management team, because and I guess you're sort of suggesting to them as we go, but you would, when I try and research what to look for, I'd read these things, people saying that, you want the management team to have skin in the game, a very good a very straightforward and a simple strategy that shareholders can understand. You want that strategy to be backed by experience and thus a good track record. But you also want them to be young. You want them to be motivated and innovative. You want them to be transparent. Obviously, you don't want them to be over promotional stuff, but you do want them to be actively reaching out to investors to be able to raise money quickly and efficiently, preferably at high stock prices. But you also don't want dilution, right? Nor do you want debt at the beginning, as you said, but you do want like 20,000 meters of drilling. So there's a lot of these things, like you don't want them to be too technically focused, but you don't want them to be only focused on raising capital and being promotional. So you have all these things that are sort of like you want one thing, but then at the same time you also want a bit of the other thing, and that's where I sort of get confused sometimes, because I'm, as a new investor, I guess I'm naive or I'm gullible or whatever. But sometimes I would notice a behavior coming from the management team where they would be like, well, this is the first time I'm entering this space. I've got no experience, but I'm really motivated. And I'd be like, okay, well, this makes sense. And then, but so when somebody says like, I'm 75, but I've got 50 years of experience, and I'm like, okay, that makes sense too. So what are some of the things to look out for here, Christian?
Yeah, these are all good points that sometimes are counterintuitive or circular. If you've been successful in the business on a major deal, your availability of cash is much better than someone that doesn't have a track record. So as you get older and you've had more successes, the money just comes to you. You don't have to spend as much time on the outreach to investors. And to a point you made earlier, if you have that track record, investors typically, especially retail, stick with that person, like a Mark O'Day or a Ross Beatty or Richard Walker or Lucas Lundin. I know investors that just invest only with those kind of guys, and that checks the box in most of the due diligence issues that we're talking about when looking at new stories. That said, when you've got someone like me, my first CEO gig, my first chairmanship gig, I do have a chip on my shoulder. I'm trying to prove myself. I'm trying to make my first few successes in the business, so I can get into that position as some of these older successful guys to have a track record and be able to raise money a lot easier. I find as you get older and you've had more successes, you can be more greedy, and you can price some of these deals a lot cheaper for yourself. Do seed stock a lot cheaper, and you can get away with it because you've had that track record, and because you're able to raise capital and because people trust you, people just look the other way. Whereas myself, at Adventus, we had no 1 cent round or 10 cent round. Our first round was 25 cents without any warrants involved. So it's much more hard slugging to get it going as your first win. So I'm not saying anything definitively on a younger CEO is better than an older CEO, or too much seed stock is too much seed stock, because I've seen it all. Does that give you a little bit of a flavor for what you're asking?
Yeah, it does. It's
and dilution. You talked about dilution.
Yeah.
Unless you're cash flowing, this business just eats capital, and you're always thinking about a strategy going back to the market. Never be too cute. Always raise capital, more capital than you can. I got quite a lot of flack at Adventus in January of this year for doing a very large equity financing when a lot of people didn't think we needed it. In fact, I lost a bunch of investors for it. But 5 months later, look where we are in the markets, and no one is calling me, telling me you shouldn't have taken that money. In fact, I get a lot of people saying, I'm glad you took that money. So being able to have sufficient cash to run a junior business, especially pre-revenue, is way more important to be able to check off your business plan than a few more percentages of dilution. So that is, I'm a former banker, so of course I've told clients that, raise more money, but I definitely don't think dilution, acting reasonably, of course, is a bad thing.
Yeah, I think that definitely does explain a lot more. Oftentimes you cannot go for debt if you're that early on, or if it's an early CEO too. That's what I've noticed. So that's a fair point. And that also, I was just thinking of, does that give me clarity? It sort of does. It stays a dilemma. And it sort of brings me to another dilemma of mine when it comes down to the place. It's something that you also recently just brought up. That'd be sort of my next P, which would be the jurisdiction of the company. And it's actually two dilemmas that are closely related to each other, really. But so again, you have people who are sort of teaching me, and they're telling me that the best place to find X, so say whatever, copper, the best place to find copper is where there is copper, i.e. they're saying look for jurisdictions where copper has been proven to occur, and a jurisdiction where like a working mine or two already exists. And that's often in combination with the advice to stay away from those flavor of the day companies, is what they call them, meaning, the companies who are chasing uranium right now, they'll switch to nickel if Elon Musk buys a mine, and then to something else entirely. But at the same time, I would guess that you don't want to get stuck with a company that's stubborn on one thing in one jurisdiction. Like they've drilled 100,000 meters next to a bigger company's project for years, and they're never moving. Even if the market is depressed, and even if there are opportunities for them to do work at a different project, they're just not moving. They're staying stubborn. So it's again some sort of a dilemma here. How do you approach that?
Yeah, I mean, winning the lottery would be something like, for lack of a better example, like Great Bear, that just got bought by Kinross. If you can find in Canada, in a recognized belt with infrastructure, at 10 to 50 million ounce deposit from scratch, it's unbelievable. It's a home run. Everyone's happy. It's the ideal situation. But exploration, I think, is misunderstood, in particular about how risky it is. I don't know the exact numbers, but my guess is 1 out of every 100 targets drilled might become a mine. And if you look at those 1 out of 100, probably 1 out of every 20 actually can get through all of the stage gates and be built because of social issues, permitting, etc. So if you're wanting to hit the home run in the mining business, which is making a major discovery and probably selling it off to someone else, and you can't limit yourself to just Canada or Saskatchewan or one jurisdiction. I think you do need to look globally. The best gauge for me is how have the mining moguls made their money? Generally, they've made their money by chasing new frontiers in the business. And let's use the Lundin family as the example here, chasing new frontiers in South America and Africa. And let's even use Ecuador, where Adventus is working. These guys got into Frutal Norte for a pretty good price when Kinross had given up. And I believe they bought the asset for about $3 a share. And through their experience in operating in emerging countries, especially from an ESG perspective, government perspective, they were able to turn that into a massive success, and it's generated a huge profit. But when you go to these emerging countries, you don't have as much competition. You can pick up these properties for cheaper, and they haven't been picked over like, let's say, the likes in Canada. So your chances for success can be higher. And many of these countries, even though the headlines may be no mining or foreign companies get lost, they are desperate for foreign direct investment. Will bend over to help you get started. It's also a matter of timing as well. Emerging countries typically go through 10-year cycles of right-leaning governments, left-leaning governments, but generally left or right-leaning governments support the mining sector. I'm going to use Argentina as an example right now. The Lundins have had a fantastic success with Filo, Josemaria, and Jexa. Actually, all used to be one company. Josemaria went for years kind of in a trading range, kind of bouncing around kind of 30 to 50 cents, not going anywhere. And then on the back of the Filo discovery, the thing rocketed up and got sold. So sometimes companies do bounce around for a while, whether it be politics or just a phase of the project. And then some kind of significant event takes them a lot higher. But now Argentina is a top jurisdiction, one of the top jurisdictions in South America for mining. And everyone is flocking, once again to Argentina. Whereas 10 years ago was a place that you couldn't be, and the Lundins will make billions of dollars out of it. So there's an example of not in our backyard in a country that was seen for a long time as not mining friendly, and now is a place to be. And Lundins have won it again. So I don't think investors should be that worried about investing in new jurisdictions because the reasons mentioned. Although there's a few that I wouldn't touch, like in Indonesia, I wouldn't go to China. I would be very careful with the Philippines, any of the Middle Eastern areas, several African countries like Somalia or Chad. Europe, very few countries will allow you to build a new mine these days. So there's definitely some off limits places, but I wouldn't be worried about Ecuador or Bolivia or Argentina. So yeah, take out a map and start looking at the world and expanding your horizons.
Well, I'm sort of two minds on this one as well, and I appreciate you bringing up the Lundins because, indeed, on one hand, you have people like Adolf Lundin, God rest his soul, or Rick Rowe, for example, as well, who learned under Adolf actually. But they're saying that he recently, what is it, yesterday or the day before that, I spoke to Rick, and he told me that the tier one deposits, the deposits that are going to make you a lot of money, they are where you find them, not where you want them. Yep. And so that stuck with me. And that basically, when you have the right deposit, even a war-torn Congo can be an opportunity. And the Lundins can say that as well. But at the same time, though, I personally, I would prefer to have some sort of a proof of concept, at least. Like, I'd like to see a government that at least wants projects over there, as you mentioned. But I also want to see maybe bigger companies that are already showing some interest in those countries, like spending exploration dollars basically in the same jurisdiction. But at the same time, that's where my two minds come in, is that if too many companies are already investing in a given jurisdiction, then that could mean that it's no longer the contrarian play, right? So what do you think about that?
Yeah. So Ecuador is a good example where it was a no-go zone for investment. No one was investing there. Lundins came in, helped change the law for mining, and then there's been a staking rush since then. So everything that was available was picked over by the majors and a few lucky juniors. You cannot pick up a new property right now for anything cheap. So the chips have been set, and so it's not the same as when the Lundins entered a few years ago. The Lundins entered on a 15 million ounce deposit that had 10 years of work on it and some de-risking. So they didn't come in kind of grassroots. So that was helpful. So yes, there's an element of it comes down to risk reward and competition as well. So Barrick Gold, looking for tier one deposits. It just did a deal in Pakistan on Reko Diq. Tier one deposit worked for 15 years with government to get to a framework that works. That's what they're really excited about. That's the growth of the company. Pakistan, of all places, because on a relative basis, they were able to get in there with little competition. And because Pakistan really doesn't have a mining industry, that's the prize geologically in the country. They've stated that they're looking for more copper projects in Africa, and they've also stated that Canada they would love to get into, but everything's too expensive. So there's another smart guy. Ross Beatty made his original big money in Chile, betting on lower grade Chilean assets. We can go down the list of how people made their money, but I go back to Adventus. We had blank check. We could go anywhere in the world to build a base metals business. We looked at 240 assets in 25 countries. We went to Ecuador. We chose to pivot the business in Ecuador because we were able to pick up a few districts for no money up front, only money spent in the ground. And from a risk reward perspective, we couldn't turn that down. Whereas these projects, if they were in Canada, we would have had to spend probably a few $100 million to get involved in them and had multiple competitors. So it's opportunity. It's opportunity cost, really.
I'm not hearing you mention Peru too many times, even though it's very close to you. And that reminds me to ask a question of what you deem more important in a jurisdiction, because they have very good mineral potential, but the latest legislative branch is sort of questionable. They're okay right now. I mean, some things are happening, but technically they're okay, but it's questionable, right? So which of those two things do you give more importance to, the rules or the mineral potential?
Peru is an interesting one. It's got an asterisk beside it. It's top 3 producer of many of the key metals. Globally, it has a very established business. The barriers to entry for new projects are quite high. We looked at Adventus, like 40 projects in Peru, and the expectations for transaction prices were not realistic. We couldn't find a deal in the country. And that's and a lot of those properties are controlled by Peruvian families that have been there for decades, and just, it's this price or we're not gonna do a transaction. I'm not sure, where Peru is going to go next. Can't keep any stability in government from top to bottom. As a result of a revolving door of ministers and even the president, no one's willing to put their name on the line and sign off on any changes. And it seems to be slipping a little bit towards the socialist side of things. That said, mining is the biggest contributor to the GDP and to taxes. My sense is that the government has let down the mining industry in some ways. In many countries, and I'm going to say Ecuador as well, the national government takes the tax and the royalty revenue, and some of that should go back to local communities to support schools and hospitals and those kind of things. And the national government is not doing that. And then they blame the mining companies for not investing in the local communities, when it's actually the government's responsibility to reinvest some of that in the community. So it becomes this vicious circle of people blaming one group versus other group. Peruvian assets right now are not favored, and no one wants to buy them. I think the view is that this is going to take some time to sort itself out. So is that an opportunity at this point, if you can get your hands on a few assets? I wouldn't at this point go to Peru. I think they're better places to look.
But so what do you value more, the legislative branch or the mineral potential?
Well, I always look at the mineral potential more than the government, because governments can normally sort themselves out. In this case, as I mentioned before, it's very difficult to get your hands on good assets in the country. Even now, it would be difficult to get your hands on good properties. So the opportunity play is not there right now in Peru.
Okay. Do you ever use something like the Fraser Institute of Mining survey? Because that's the two things that they research for, or is that not something that professionals would use?
Some companies like to highlight it. I don't really look at it. I rather look at companies that are operating in the specific countries, talk to them, get a sense of what's moving or not moving. You can find top-rated Fraser Institute jurisdictions where you can't get a permit. For example, Quebec is up there, but you can't build a uranium mine. And there's other unique circumstances here and there. So I would go a little bit further than just those ratings.
Okay, fair enough. So one thing that I find that survey is failing to mention is stuff like the social aspect and community, right? Because it's becoming increasingly more and more important. It's always been, but at least it seems to me that it's becoming more and more important, especially with all the mine cancellations and permits that fell through in the last 2 years because of like protests. And that's not only coming from like First Nations or natives or whatever we want to call them. Sometimes it's just farmers who don't want their jobs taken away and that kind of things, right? So I guess that's also one thing to look at. How do you look at that, by the way? Do you pay close attention to that?
When you do due diligence on projects, in most cases, social should be the top of the list for companies. I really focus on the United States on that topic. I mean, they're the richest and most successful, country in the world in many respects. They desperately need raw materials for strategic reasons and for the climate change purposes, etc. But the United States is becoming the worst country in the world to permit a new mine, especially, and maybe we can remove Nevada, but even Nevada, if you want to permit a project for just exploration and it's on federal land, it's going to take you 2 to 3 years just to do drilling. The United States, in my view, is, if not the most difficult, up there in terms of permitting. And it's to your point, no one wants to have a mine in their backyard. They're too good in many cases to have it, or their perception is it's going to, dirty the environment. Mine should be in other countries, and we'll just buy the products from them. And there are at least half a dozen major copper projects in the United States, some of which should be a rubber stamp, in my opinion, that may never get permitted. And some of these are big projects. We all know about the Pebble project in Alaska. I think Hunter Dickinson, despite all the issues over the years, developed a pretty smart kind of small footprint project. The Resolution mine of Rio Tinto and a BHP, I believe, in Arizona, that they've sunk a shaft 1 kilometer deep. That's going to be a large underground mine, and they can't get the permits to build a surface infrastructure. That one to me is a no-brainer. Why wouldn't you develop that? And I can go on. Polymet in Minnesota, they have 100,000 ton per day mill already built. They got a tailings facility built for, I think, 20 years or so. Can't get their final permits to put the mine in production because the first time it's a sulfide mine rather than iron ore mine in that range. That's really silly, in my opinion. And it's just because it boils down to, I think, politics and who are the donors for the different political parties living in the backyard of these mines. And if you, if someone is a key political contributor to whatever party and they don't want the mine's not going to get built. So, yes, there's those aspects of it. I don't like how some people just brush BC and just say you can't build a mine in BC if the First Nations are an issue. Every jurisdiction, going down to even counties or cantons, those kind of things, will have areas where you can build mines and you can't build mines. And in a large part of British Columbia, you're going to find First Nations supportive of building mines. You just got to do your research and understand how the company operates, and go from there.
Okay. Yeah, that makes sense. I'm following a couple of companies that are dealing with those issues, so I think it's going to be a learning moment for me specifically. And yeah, I guess to sort of keep it moving there, now that we've spoken about the management and the jurisdiction more in depth, let me ask you this. Do you think that the right management can make even the worst jurisdiction work, or is it the other way around? The worst jurisdiction would never work. Even the best management would never make a bad jurisdiction work.
Well, I said before that emerging countries, which some of you could claim are bad jurisdictions are actually good places to develop mines. Maybe a lot easier than the United States. So I would be careful to call a jurisdiction. If you're going to claim a jurisdiction is bad, I wouldn't necessarily say that it may be bad for the mining sector. I think United States, going back to that example, you can have the best management team ever, and you can't get a permit for a significant mine. So I don't know if they're completely tied together. But I go back to Lundin's example. They've got a playbook, their foundations, the way they deal with government, social programs in the communities. There are some groups that are better suited for emerging countries than others and will have a higher chance for success. So there's no black and white answer to that question.
Okay, that makes sense because it's right. So you check the jurisdiction, and if it's impossible, obviously nobody's going to make it work because it's impossible. You go to Greenland, they've said no mines. That's it. Nobody's going to make it work. But if it's really, really, really hard, then you say, okay, let's look at the management team. And if you have a green light, then it's when you'd move on. Okay.
I give Skeena as example in British Columbia. Skeena is in the Tahltan lands. Tahltan have shut down several mining projects. But that management team, through being creative and I think working closely with the First Nations, have been able to develop such a strong relationship that the Tahltan invested in the company, equity, and they mutually agreed to set aside part of the land on their key project for kind of park purposes, and agree to kind of forge forward on the mining project. So I don't know who made those decisions, but there were good decisions, good outcome, and that's, I think, I have a good sense that is a good management team that can think outside of the box and work through what other people would say may be a difficult area.
Yeah, exactly. That's a great example of it. Thank you for sharing that. And one other thing that they do have, though, is I sort of know Skeena, I used to follow it. They have a good project, right, to begin with as well, and that's also one of my other P's. So that it's even a nice segue into the other P, which is the project. However, though, I think it's everybody watching this would know this, but when it comes down to geology, I'm trying to understand it, but I'm probably the first thing from a geologist you ever meet, and so, but I guess many other retail investors aren't geologists, and then they have a hard time dealing with the geology. And I have a suspicion, by the way, that this is exactly where some more technically versed companies might try to sort of blind this with technical jargons and cover up potential issues that might make it so that the project either never gets bought, or if they're trying to develop it, that it never goes into production. So I guess it's going to be a very general question, but how do I protect myself from getting got on the technical side of things, Christian?
Well, you go back to the very first rules I laid out. Who's on the board? Who are the major shareholders? If you get comfortable on that front, those people and those investors probably are more savvy than you and have done their due diligence and probably more comfortable from a technical perspective. So not always, but most of the time that would be the case. No one is going to join a board of directors of a mining company if they're not satisfied with doing some level of due diligence, because they ultimately have the liability, and people in the mining space are limited to how many boards they can be on. So you want to keep that opportunity cost open, that optionality. So you better love what you're involved in if you're going to be on a board. But going back to geology, I think the most risky opportunities in the mining space are twofold. Underground gold mines, just generally. They are very difficult resources to calculate because of various phenomenon, none the least being the nugget gold effect. So you drill a hole, you get some nuggets of gold. Now you start extrapolating your resource that there should be other nuggets of gold around you, but there potentially might not be. And you need to have very tight spacing of drill holes in order to determine if the nugget gold effect actually spans the resource or it was just isolated in a certain area. That can skew the grade substantially. So there are other aspects to gold geology and resource estimation that is difficult, but then you add in an underground mining scenario where you need to pinpoint exactly where you're going to drive the adits or the mining method you're going to use. And so a lot of these underground gold mines that are being built are really challenging. And in Canada, there have been a few over the last few years. TMAC up in Northwest Territories, which is now owned by Agnico, they've also had logistical issues, mill issue. But in Ontario, you had Hart Gold. You also had Rubicon. You also have now Pure Gold. And it's not necessarily that the gold isn't there, but it takes a lot of more infill drilling, resource definition work, mine planning work, and it may be the second or third owner of those kind of deposits that actually figure it out. So I would definitely be worried about those type of deposits. And I also would be worried about entering into metals that are not well known in the markets. I mean, it's not a geology question, but when you think about things like niobium, tantalum, vanadium, that end of the spectrum, manganese, those are specialty metals that do not have a transparent market. Most of them are opaque. You got producers that control those businesses and therefore control the price, and you can get slaughtered in that kind of investment. So that's why when you look at my portfolio, it's pretty well all copper, nickel, copper, gold, royalty companies. And I typically like base metal exploration deposits companies better because copper porphyries are much easier to model, much more repeatable. Metallurgy is typically the same over kind of porphyry deposits. So the chances for technical issues, ramp up issues, etc., are much less.
It also sounds to me like, and I wrote it down, that consistency is important too, because that's what you don't get with nuggety gold systems, right? One time you're going to drill, it's going to be very high grade, and then the next time you drill, and it's dust.
Yep.
So it's hard to deal with. So consistency, that's important, huh?
In simple terms, consistency is exactly what the issues are for a lot of these gold deposits. So there's a bunch in Quebec. I won't name any names that I would be concerned about. Also, ones that perhaps were underground mines in the past and now are becoming open pit mines, and they're stretching the resource estimation and strip ratios going way up. Just be wary of these things. They can be a promoter's dream as well, showing I've got 2 million ounces at 4 grams now in some bulk underground mining scenario, but it's not a bulk mineable deposit. So yeah, there's a bunch of games being played on that front.
Well, I want to talk about that, although I obviously respect your desire not to mention any company names, but let's talk about some of the technical shenanigans that happen, or sort of red flags to look for when it comes down to, I mean, I've recently learned about stuff like grade smearing and gold equivalent reporting when you have like 15 metals and you equivalent them all to gold and stuff like that I've learned about, but what are some of the less known technical shenanigans to stay away from?
Well, there's some gold deposits that you're going to look at and have, let's say you got 5 professional resource estimators, and each of the 5 are going to come up with a different result. In many cases, it's not a matter of is the gold there. Generally, the ounces of gold are there, but the tons and grade are different, and that ratio can substantially change the economics of the project. And it comes down to area of influence, nugget gold effect, so capping some of the higher grade gold intercepts in a drill hole. And a lot of times in the junior space, you can pick your resource estimator based on track record and what kind of result you want, and maybe even able to influence the outcome. So I know one of the largest gold companies in the world, a friend there runs corporate development. Just the very first thing they look at when they're evaluating a resource is who the resource estimator is. And that will tell a lot about, is this apples to apples type of resource estimate compared to their existing resources and reserves, or we need to completely recut that. So I would say that there's a very wide spectrum in the gold estimation space. And you can have quite a promotional one, or you can have quite a conservative one. The results can vary dramatically. And then you start getting into is this an open pit or underground? What can you push in terms of strip ratio or bulk underground mining? Bulk underground mining is not easy to do. You need to have experience in it. There are very few operators. Agnico is an excellent operator at it. And your costs from a mining perspective can vary substantially based on stability of the rock underground, development costs, etc. So when doing due diligence on projects, for let's say underground projects, you can have a variance of, call it $50 per ton to $150 per ton very easily, just based on your desktop work. And that will either make a project look amazing or kill it. And you just need to do the proper work and have good mining engineers to evaluate the resource and model it accordingly. So there's a lot of concepts there, but because there's so many concepts to play with, you can see how easy it is to develop a preliminary economic assessment in the gold space and make it look fantastic, and it will not work out.
Yep. Oh, yeah. I've even seen some of those in my brief experience as a natural resource speculator. And also I read something recently about the natural instrument 43-101 and I-43-101, is that it's that report and publishing data that is compliant with that report, that's really what it is. It's not like that report in Canada. It does not necessarily protect you from bad projects or anything. It just says that the company filed it in a compliant way with that project, but it can turn out not working even if they follow the regulations around it. So that's a good point as well. And I guess we cannot really cover all red flags, right, when it comes down to the geology, because there's a lot. So I was just thinking to sort of keep it moving, and the next logical step would be to talk about the company's plans for the future. Like, okay, they have the good team, the good jurisdiction, they maybe have an interesting project down there. What can go wrong in terms of what they plan on doing with it?
Well, I'm going to use Richard Work as a case study on that question. The ideal way to make money in the business is to I'd say the risk, lowest risk, easiest way to make money is to go to a deposit or a discovery that's already been made, with a view that it can be expanded substantially through exploration. So playing the first leg of the Lassonde curve, if you know what that is or what your viewers are, so that the first exploration phase where how big is it? How much bigger can it get? And trying to expand, get it to a point, maybe a first resource or about to be a first resource, and then sell it off. Richard has done that a few times. He's trying to do that with Solaris here in Ecuador. The risk with that is that after you've climbed that first leg of the Lassonde curve, you're too early stage, or there are too many question marks, or you're too expensive that you can't sell it. And then you get into the Lassonde, you start entering the Lassonde trough. So that is the many years of heavy spending for not much excitement from a market perspective, to go through the PEA phase, the pre-feasibility study phase, the feasibility study phase, the permitting, raising the capital, etc. That's what Adventus just has gone through. It's a lot of work that the market does not really appreciate. Your share price is going to suffer. And the hope is, after all of that, all those years and spending, that when you finally get into production, it actually works, and you haven't taken too much dilution over those years, so that the rise up at the end gets you to a higher price than what you were at the peak on the first leg up on the Lassonde curve. So a lot of companies, or most companies, don't have the benefit of kind of Richard Wark's success, or that first leg of the Lassonde curve. So they get stuck in this trough, and they just can't raise sufficient capital to take it through all the stages and the stages properly. Most projects here, you spend at least, or Mike, say $50 million to go from that first leg up on the trough to kind of a fully permitted phase. Most companies can't raise that. So then, is it worth companies spending the money to advance those projects through the different phases? Is the real question. In most cases, it's yes, because if you don't, your company is dormant and it's going to go to zero. So what really drives value in this business is exploration success. That's where the market is focused on right now. But we talked about earlier how difficult it is to be successful. And then it is execution. Well, that's one. Another one is identifying assets off the beaten path, doing good deals on it. And then the third way would be executing on construction and operations. So exploration is, even for the best people in the business, a roll of the dice. So if you can find it, like the Great Bear, hats off to them. Finding good assets globally, off the beaten path, doing good deals. Those are typically the very successful entrepreneurs in the business, the Lundins, the Richard Warks, the Ross Beatties. They got a good nose for them, freelance, and they also have the best people around them to help identify them and bring them opportunities. And then the best groups in terms of execution on a project, because building mines, in my view, is the hardest thing to do of any industry on the planet. A Lundin Mining is an excellent group. First Quantum is probably the best in the copper space. A B2 Gold in the gold space. Alex Black has a good track record in the gold space with Rio 2 now. Those are the three levers, I would say, to really hit it out of the park.
That's a very good overview. And you said, is it worth spending money on exploration? Oftentimes the answer is yes, especially with the companies that you mentioned, and I like that, because I often ask myself that question as a sort of a finance guy, although not a very good one. I ask myself that question: is it like the things that companies are spending money on, is that really worth it? And that actually brings me to yet another P, and I'm going to keep it moving because I know you don't have too much time. That'll be the promotion, and basically paying to tell the story. Let's say that all checks out so far. You still got to be able to tell the story. But there's multiple red flags that I see in there as well when it comes down to promotion, especially management teams who are over promotional, or spend as much money on marketing as they do on drilling. Like that's an obvious no-go. I mean, that's an obvious red flag, not necessarily a no-go, but one thing to pay attention to. But what else do you see in terms of promotion? I guess we could write a complete book on it, but what are some of the basics to watch out for?
The type of outrageous promotion that I've seen in the mining sector seems to be more in Canada than in Australia. It's a problem. It can get hidden in your financial statements, but some companies I know are spending $2, $3, $4 million on paid promotion, which I think is way too much. And the type of shareholders you get for that typically are the first ones out the door in kind of the shakeout over the last few weeks. So I'm wary of the paid promotion side of it. I think occasionally it might have its spot in very surgical type situations, but maybe a few $100,000 here or there to get a little bit more eyes on something. But the way I operate is I'm an open book. If someone wants to talk about Adventus or Surge or mining, I will make time to talk to you. That's rare in the business. Some companies are great in retail marketing. I think if you want to have the ability to raise the type of money in Adventus has raised, for example, you need to spend serious time and money pounding the pavement in all around the world, telling the story to institutional investors. Institutional investors have been a huge win for Adventus to be able to raise all the money we have. They've also have interesting trading reasoning sometimes. So we've got hit pretty hard since January at Adventus with institutional selling, but on a net basis, I'd much rather take that institutional money than not have it. So you need to have a management team that is willing to put their neck out, market to all types of investors, build a relationship with institutions, be able to build relationships with corporates. And if someone's just sitting at home, hoping that their next drill hole is going to bring a 20 times return on their share price, those companies are going to go nowhere. I see the mining business, going back to the $1,500 companies in Canada, as being very competitive. This mining boom that we may be in based on the prices hasn't translated a lot of new incremental money into the business. So everyone's chasing for that incremental dollar, and those 1,500 companies are chasing for that extra dollar. And so you got to do everything you can to try to attract that money, whether it be through treasury offerings or kind of new shareholders on the register. So I think you can do it without promotional dollars. I think you can do it just through hard work and perseverance. And I do think the conference program has gone way too crazy. I mean, there's a conference every 2 weeks. You're seeing the same people every single time. It's an opportunity to get in a plane and have a few drinks and there and that. But I think some companies do too much of that and should really pinpoint a few conferences during the year. That can blow a ton of money very quickly.
I think that you made a good point where it came down to the best marketing is the one that you don't have to pay for. You get in front of the camera, you talk about the things that you know, if you actually know these things, like you're doing here. And now, obviously, you've mentioned Adventus a couple of times. You're not paying me to host you here. I'm not yet a shareholder of Adventus, so I'm not going to say I'm never going to become one because it's a probability for me. But you're sort of proving yourself up, and you're building up a relationship by being active on Twitter and answering questions and stuff like that. I think that can go you a long way, a longer way than what it used to be, where you have to pay for that promotion.
The most successful medium for marketing or promotion, call it, outside of just meeting with institutions on kind of a roadshow with a broker has been Twitter. I had a few institutional accounts suggest I joined Twitter just over a year ago, and I've really enjoyed it. I think the people that are focused on the resource sector are passionate about it. They know a ton about it. You follow some of the guys or girls on it, you can make a ton of money on it. I'm really impressed. But if you are, as you say, transparent, you're open, you're involved in the dialogue, I think that can only help your reputation as a CEO. And my hope is that translates eventually. And okay, this guy knows what he's talking about. I want to take a dabble in the companies he's involved in. I would say on Adventus and Surge, my guess is that we picked up between $3 to $4 million of buying from people just on Twitter. It's my time, so there's a cost to it, but it's not hundreds of thousands of dollars or even millions of spending for the incremental buyer.
Mm. Yeah, there's also you say there's a cost to it. It's my time. I really like thinking in terms of ratios. So whenever I'm hosting a company to the CEO barbecue, I would ask them how much money you're planning on spending on marketing and who are you going to spend it with? Because that, to me, that matters too. Because there are groups out there that are over promotional. So that matters to me too. But I ask them how much you're going to spend relative to other things. Like how much are you spending relative to the amount of drilling that relative to the amount that you're going to spend on drilling? How much are you spending relative to your personal paycheck? How much are you spending relative to your investment in the company? Because if a CEO, has picked up a couple of million shares at a tenth of a penny or something at the seed round, and then they paid $15 for it, but then they're spending 15 million a year or whatever, 1.5 million a year to make it more realistic on promotion. It doesn't make any sense to me. It already tells me a story. So that's something that I like doing. Did you think that's an okay approach to approach it with ratios, or does that not make sense?
Yeah, I know CEOs that got a kind of 1 cent round and just options or RSUs and never put hard dollars in the business and made millions of dollars out of it. So there is something to be said about CEOs that put their hard cash into the businesses. I put several $1 million of my money into these two businesses, Surge and Adventus. So there's definitely something to be said, and a ratio I think is a good way to look at it too. Maybe it's not only a ratio of, let's say, the CEO salary, but it could be a ratio of their overall budget for a company in a year. I mean, if there have been examples with Vancouver-based companies of $6 million, $7 million budgets, where $5 for a year and $5 million has gone to administrative and promotion of the 7. That's outrageous.
You're making me move to Vancouver and start a promotion company, get $5 million. I'm just kidding, of course. Yeah, I know you almost have to leave, Christian. So say that I looked over all of these things and I didn't find any major red flags, and I have an interest to sort of continue following up with the company, whatever. What do I pay more attention to? Like, what do you want to say as a sort of closing off thought?
Yeah, if you've gone through the directors, the investors, maybe jurisdiction we talked about, you feel like there's adequate money being spent on promotion, but also not too much, all these things we talked about, I would suggest that you, as an investor, it doesn't matter if you want to invest $10,000 or $1 million, you try to have a conversation with management. As I said, I'm open door to anybody who wants to speak about Adventus at any given time. I think management should value those anybody who's interested in the company and start that kind of relationship. Albeit if it's a multi-billion-dollar company, perhaps the CEO doesn't have that time, but someone on the team, someone investor relations, should be available to have a conversation. That shows that you care about the incremental investor. So if you reach out to a company and it's silence, I don't think that's a good sign. It doesn't mean it's a bad company, but to me that means something. And if you start, this is a thing from an institutional side that I've found over the years. I've had to go see institutions 2, 3, 4 times before they finally invest. So what are these institutions doing? They want to meet you, look at you in the eyes. They want to hear what the plan is. Then they want to see it next time to see you execute on the plan, and then on and on and on. And if you can prove that track record of being executed each time you see them, then you build up the trust that they write a check. I think retail investors should think of it similarly. You don't need to invest the day of. Do your due diligence, speak to management, get comfortable there, see if they execute over one or 2 month period. Maybe you start with a small position in that company if you feel comfortable, and after they execute over time, you put more and more money into that name, and I think that's your best bet.
That's a very, very good overview. That's something that I've been saying because I obviously reach out to companies for interviews every now and then. And when they don't get back to me, I've been talking about it. I haven't really thrown out their name publicly or whatever, but I've been talking about it. And some people would disagree with me, but it makes sense to me that you would have somebody showing interest in the company, at least get back to them in an email or something like that. And sometimes it's small companies, sub $100 million market cap. And if they don't answer, now then I'm starting to think about like, hey, what's going on? Like, this is not a $5 billion company. You probably have the time to send an email, even if it's like, we don't have time for you right now, but we'll get back to you at a later point, something like that. So something that I've been paying attention to. Yeah. Christian, this has been really great. Thank you for investing your time in me. Is there something that you wanted to talk about, but I failed to bring up?
I think we're good for this session. I appreciate you giving me time too, and I hope your viewers like it and have some questions and want me on for another time.
Oh, definitely, because I want you on for another time. We're gonna. I intended on talking about copper, but this went on for quite a long time. So I hope you're gonna come back. I want to talk about Surge because I've recently become a shareholder. I want to talk about Adventus too. So I definitely hope you're gonna come back. So yeah, thank you for investing your time in me.
Cheers.